There is a powerful, almost mystical force at the heart of the world's greatest fortunes. It's a secret that hides in plain sight, a principle so counterintuitive that 99% of people who attempt to build wealth in the stock market will never grasp it. We are taught from our first breath that success comes from action, from effort, from hustle. We are told to strive, to push, to constantly be doing something. But what if the greatest financial advantage you could ever possess lies not in frantic activity, but in disciplined, strategic, and often profoundly difficult inaction? What if the path to true financial freedom, to the kind of generational wealth that seems reserved for legends, is paved with the things you choose not to do? The man who best embodies this paradox is Warren Buffett. But his genius is not in some complex algorithm or a secret source of information. His genius lies in his mastery over his own impulses. He has cultivated the profitable, world-changing habit of doing nothing. He understands that great investment results don't come from trading frequently or chasing the latest hot trend. They come from buying a piece of a truly wonderful business and then having the fortitude to sit on it. To just sit. For years. For decades. This is the final promise of investing. Not the thrill of the trade, but the quiet, relentless, unstoppable power of ownership. Over the next hour, we are going to deconstruct this principle, piece by piece. We will dismantle the costly market mistake that the constant urge to act represents, and we will rebuild your entire investment philosophy from the ground up. You will not just learn a new strategy, you will undergo a financial transformation, cultivating the patience to let your best ideas compound into a fortune. This isn't about beating the market in the next quarter. This is about letting the market build your dynasty over the next quarter century. This is how you get rich by doing nothing. The entire philosophy, the foundation upon which this fortress of wealth is built, can be captured in a single, powerful mental model that Warren Buffett shared decades ago. It's an idea that, once understood, makes frenetic trading seem not just suboptimal, but utterly insane. He called it the punch card mentality. This is the first pillar of strategic inaction, the power of extreme selectivity. Imagine, he would say, that when you are born, you are given a punch card with only 20 slots on it, 20 punches, and that is every single investment decision you are allowed to make for your entire life. Once you've made 20 investments, you're done. You can't make another. Every time you buy a stock, you punch a hole. That's it. Think about how that would change your behavior. You would stop listening to the noise. You would stop chasing tips from your brother-in-law. You would stop buying stocks based on a talking head you saw on television for 3 minutes. Every single decision would be treated with the gravity of a life-altering choice, because it would be. You would conduct research so deep, so thorough, that you would know the business better than anyone on Wall Street. You would wait, patiently, for the absolute perfect pitch, the one single opportunity that you were certain was a home run. And when you found it, you would invest with enormous conviction. You would bet big, because you have to make each of your 20 punches count. This isn't just a clever thought experiment. It's the very mechanism that forces an investor to adopt the discipline required for long-term investing and to avoid the siren song of constant activity. It is the practical filter that allows you to do nothing because you have done everything necessary before the purchase. The foundational anecdote that perfectly illustrates this principle of extreme selectivity and conviction took place in the turbulent heart of the 1960s. It's a story not just of financial acumen, but of psychological fortitude in the face of absolute panic. It is the story of the great Salad oil scandal and Buffett's career-defining investment in American Express. In late 1963, the financial world was rocked by a scandal of almost comical proportions. A company in New Jersey called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, had perpetrated a massive fraud. DeAngelis had discovered that he could borrow vast sums of money by using his inventory of salad oil as collateral. The problem was most of the salad oil didn't exist. His company used a simple but brilliant trick. The massive storage tanks were mostly filled with water, with only a few feet of oil floating on top. When inspectors came to check, they saw oil. The company had managed to secure loans against 1.8 billion pounds of phantom salad oil. When the fraud was uncovered, Allied crude vegetable oil collapsed overnight, defaulting on over $175 million in loans, an astronomical sum at the time. The fallout was catastrophic, and one of the biggest victims was American Express. Unbeknownst to the public, a subsidiary of American Express ran a warehousing division that had guaranteed the authenticity of Allied's salad oil inventory. Suddenly, American Express was on the hook for tens, perhaps hundreds of millions of dollars in losses. Wall Street panicked. This was a blue-chip, trusted institution, the bedrock of travelers' checks and credit cards, and it was now facing potential bankruptcy. The herd mentality took over. Investors, terrified, dumped the stock. The price of American Express plummeted by nearly 50%, wiping out hundreds of millions of dollars in market value. The consensus was clear: get out, and get out now. This was a classic Mr. Market scenario, a wave of pure, unadulterated fear. For the average investor, the impulse, the overwhelming urge, was to act, to sell if you owned it, and to stay a million miles away if you didn't. But Warren Buffett saw not panic, but opportunity. This was a potential punch on his 20-slot card, and he was going to treat it with the seriousness it deserved. He didn't just look at the stock chart, he went to work. He began a forensic-level investigation into the underlying business reality of American Express. He didn't rely on Wall Street reports or newspaper headlines. He did his own primary research, the kind of scuttlebutt investigation that defines the punch card approach. He went to banks, he went to merchants, he visited restaurants and hotels. He stood in lines and observed customers. He wanted to know one thing: had the scandal damaged the core business? Had people stopped using American Express travelers' checks? Had merchants stopped accepting the American Express card? He talked to cashiers. He talked to competitors. The answer he found, again and again, was a resounding no. The underlying business, the actual franchise in the minds of consumers, was completely unaffected by the warehousing scandal in New Jersey. People still trusted the little green card. Travelers' checks were still seen as good as gold. The financial liability, while significant, was a one-time hit. The brand, the moat, the actual engine of profit, was intact. He had done the work. He had gained the conviction. He knew the business inside and out. So while Wall Street was screaming sell, Buffett calmly and deliberately began to buy. He invested 40% of his partnership's assets, a sum of $13 million, into American Express stock. This was not a small speculative bet. This was a massive, high-conviction punch on his card. And then, having made his move, he executed the most important part of the strategy. He did nothing. He sat, he waited. He allowed the market's panic to subside, and for the company's powerful, underlying earnings power to reassert itself. Within a few years, the stock had recovered and then soared, multiplying his investment several times over and generating a $20 million profit for his partnership. This single decision, born from extreme selectivity and exhaustive research, put him on the map. It was a masterclass in ignoring the crowd and focusing on business fundamentals, the very essence of the punch card mentality. It shows that the hard work isn't in the buying and selling, it's in the deciding. Once that punch is made with absolute conviction, the discipline of passive investing becomes the default and most logical course of action. The psychological principle that makes the punch card mentality so effective is a powerful cognitive force known as commitment and consistency bias. This is the deep-seated human need to be seen as consistent in our beliefs and actions. Once we make a decision or take a stand, we experience internal and external pressure to behave consistently with that commitment. The punch card is a mechanism that weaponizes this bias for our own financial benefit. Think about the difference between making a casual investment versus a punch card investment. When you casually buy a stock based on a whim or a hot tip, you have very little psychological skin in the game. Your commitment is shallow. When the stock drops 10%, it's easy to panic and sell because your initial decision wasn't anchored in any deep conviction. You are not betraying any core belief by selling. You are simply cutting a casual bet that went wrong. There is no psychological pain associated with being inconsistent, because there was no real commitment to begin with. The punch card framework completely inverts this. By artificially limiting your decisions to just 20, it forces an enormous upfront investment of time, energy, and intellectual effort. To punch the card, you have to conduct the kind of deep dive Buffett did with American Express. You have to read years of annual reports, study the competition, understand the management, and build a detailed valuation model. By the time you actually make the decision to buy, you haven't just made a financial commitment. You've made a profound intellectual and psychological commitment. You have publicly, at least to yourself, declared, "This is one of the 20 best ideas I will ever have in my entire life." Now, what happens when the stock drops 10%? The commitment and consistency bias kicks in with incredible force. Selling would mean admitting that your exhaustive research was wrong. It would mean admitting that one of your precious 20 slots was wasted. It would create cognitive dissonance, the mental discomfort experienced when holding two or more contradictory beliefs. Your brain, seeking to resolve this dissonance and maintain a consistent self-image as a smart, diligent investor, will default to holding the position. It will force you to revisit your initial thesis rather than reacting to the price. You'll ask, has the fundamental business story changed? Not, why is the price going down? This is a subtle but monumental shift in perspective. The bias transforms you from a reactive trader into a steadfast business owner. It acts as an automatic defense mechanism against market volatility and the emotional whims that drive the 99% of investors who fail. They are trapped in a cycle of shallow commitment, leading to frequent inconsistent actions. The punch card investor, on the other hand, uses the power of deep commitment to enforce the discipline of inaction, which is the key to long-term compounding and effective portfolio management. It's a psychological judo move, using a quirk of our own minds to protect us from our worst impulses, ultimately paving the way toward financial freedom. So how do we, as retail investors, translate this powerful idea into a practical, applied mental model? We can create what I call the blueprint for the 20-slot punch card. This is a step-by-step process to force extreme selectivity into your own investment decision-making, transforming your approach from casual speculation to professional asset allocation. Step 1 is the physical or digital manifestation of the card itself. Create a document, a spreadsheet, or even a physical index card. Label it, "My Lifetime Investment Punch Card." Create 20 numbered slots. This isn't just for show. It's a powerful visualization tool. Before you even think about buying a stock, you must look at this card and ask, is this idea truly worthy of permanently occupying one of my 20 slots? The immediate gravity of that question will filter out 90% of the low-quality ideas that bombard you daily. Step 2 is the creation of a conviction checklist. This is a non-negotiable list of criteria that a company must meet before it can even be considered for a punch. This is your personal quality filter. Your checklist might include items like a durable competitive advantage or moat that I can clearly explain in a single paragraph, a history of consistent and growing free cash flow, a return on invested capital above 15% for the last decade, a management team with a clear track record of integrity and intelligent capital allocation, and a business model that I can understand as well as I understand how my local coffee shop makes money. This checklist must be brutally difficult to pass. Its purpose is not to find companies to buy, its purpose is to find reasons not to buy. Step 3 is the red team exercise. Once a company has passed your checklist, your job is not to confirm your idea, but to try and destroy it. For a full week, your only goal is to find every possible reason why this would be a terrible investment. You must actively seek out the most bearish, negative reports you can find. Argue the bear case to a friend or family member with as much passion as you can muster. The goal is to subject your thesis to the ultimate stress test. If, after a week of sustained intelligent attack, the investment case still stands tall, you move to the next step. If it falters, you thank the process for saving you a precious punch. Step 4 is the valuation mandate. You are not allowed to punch the card unless the company's stock is trading at a significant discount to your conservative estimate of its intrinsic value. This is the margin of safety principle. You must write down, in plain dollars and cents, what you believe the business is worth per share. Then you must write down the price at which you are willing to buy. This creates a clear, unemotional trigger. You do not buy because the stock is going up. You buy only when Mr. Market offers you a price that meets your predetermined discount. Step 5 is the final commitment, punching the card. When you finally buy the stock, you physically or digitally mark off a slot. You write down the company name, the date, your purchase price, and a one-page summary of your investment thesis. This document becomes your anchor. This entire process, the visual card, the checklist, the red team exercise, the valuation mandate, and the final written commitment, is designed to be arduous. It's designed to be difficult. It makes investing a rare and significant event, not a daily habit. It leverages commitment and consistency bias to your advantage, ensuring that by the time you invest, your conviction is so high that the inevitable market volatility will seem like irrelevant noise. This is the blueprint for building a portfolio of a few wonderful businesses that you can confidently hold for the long term, which is the cornerstone of any serious wealth management strategy. Now let's explore the antithesis, the path walked by the overwhelming majority of market participants. This is the path of the 99%, and it is paved with good intentions but leads, almost inevitably, to financial disappointment. It is the path of diversification. The term, coined by legendary fund manager Peter Lynch, describes the process of adding more and more investments to a portfolio in a way that the overall quality and potential for returns actually decreases. It is the exact opposite of the selective, high-conviction punch card mentality. The average retail investor, driven by a misunderstanding of diversification, believes that owning more stocks equals less risk. They are told that don't put all your eggs in one basket is the gospel of investing, so they buy a little bit of this, a little bit of that. They own 50, 100, or even 200 different stocks, or worse, a dozen different mutual funds that all own the same 500 stocks. They feel safe. They feel diversified. In reality, they have built a closet index fund that is guaranteed to achieve mediocrity, but they are paying the high fees and incurring the high transaction costs of active management. The psychological driver behind diversification is a fear of being wrong, coupled with a lack of true conviction. Because the investor hasn't done the deep work required by the punch card model for any single holding, they don't have the confidence to make a concentrated bet. Their portfolio is a collection of hopes, not convictions. They hope the tech stock goes up. They hope the dividend stock doesn't cut its payout. They hope the international fund will finally have a good year. Hope is not an investment strategy. Consider the typical journey of an investor on this path. They open an account, funded with their hard-earned money. The sheer number of choices is overwhelming. So they turn to the financial media. They see an analyst on TV touting a breakthrough biotech company. It sounds exciting. They buy a few shares, no punch card, no checklist. A week later, they read an article online about the boom in renewable energy. They buy a solar stock. A friend at work tells them about a can't-miss cryptocurrency. They allocate a small position. Within a year, their portfolio is a chaotic, untended garden of 30 different positions they barely understand. They don't know what these companies really do, who runs them, or what they're worth. They only know the ticker symbol and the color of the number next to it. Then the inevitable market correction comes. The portfolio drops 20%. Panic sets in. Because there is no anchor of conviction, no memory of a rigorous decision-making process, their only guide is the flashing red of the screen. They sell everything, locking in their losses, vowing that the market is a rigged casino. Diversification creates a portfolio that is too complex to understand and too fragile to hold. It is an admission of ignorance, disguised as prudence. Buffett himself famously said that wide diversification is only required when investors do not understand what they are doing. The punch card mentality is the antidote. It forces you to understand. It forces you to build a portfolio of a few high-quality businesses that you know, inside and out. It's the difference between being the curator of a world-class art collection and being a hoarder in a house full of junk. Both may have a lot of stuff, but only one has created true, lasting value. The path of the 99% is a flurry of activity that ultimately cancels itself out, leaving them with nothing but transaction costs and regret. It is the illusion of sophisticated portfolio management, without the foundational work that creates real returns. The direct financial connection between the punch card mentality and building real wealth is both profound and mathematically undeniable. It impacts your bottom line in two critical ways, through the power of concentration and the avoidance of costs. First, let's talk about concentration. The dirty secret of the investment world is that diversification, while protecting you from catastrophic single-stock blow-ups, also guarantees you will never achieve extraordinary returns. By owning a little bit of everything, you are mathematically destined to get the average result, minus fees. True wealth, the kind that creates financial freedom, is almost always built through intelligent concentration. Look at the fortunes of the world's greatest entrepreneurs and investors. Bill Gates didn't get rich by diversifying into 100 different startups. He poured his life into Microsoft. Jeff Bezos focused on Amazon. And Warren Buffett, for all his folksiness, has always run a remarkably concentrated portfolio. For decades, a huge percentage of Berkshire Hathaway's public stock portfolio has been concentrated in just a handful of names: American Express, Coca-Cola, Apple. The punch card philosophy forces you into this world of intelligent concentration. By limiting yourself to 20 decisions, you are compelled to make each one count. When you find a truly exceptional opportunity, you don't just dip your toe in, you take a substantial position. The financial impact of this is explosive. Let's run a simple scenario. Investor A, the diversifier, spreads $100,000 across 50 different stocks. Investor B, the punch card investor, puts that same $100,000 into just 5 of their best ideas. One of Investor B's stocks turns out to be a 10-bagger. It increases in value by 10 times. Their $20,000 position becomes $200,000. This single winner doubles their entire portfolio. For Investor A, that same 10-bagger was only a $2,000 position. It grows to $20,000. It's a nice gain, but it barely moves the needle on their overall portfolio. As Buffett's partner Charlie Munger says, the first rule of compounding is to never interrupt it unnecessarily. And the surest way to get mediocre results is to have your best ideas diluted by your 47th best idea. The second financial connection is the dramatic reduction of costs. There are two primary costs that erode investor returns: transaction fees and taxes. Every time you buy or sell a stock, you incur a cost. For the hyperactive trader, the diversifier who is constantly churning their portfolio, these small costs add up to a massive drag on performance over time. It's like trying to fill a bucket with a hole in it. The punch card investor, by definition, trades very, very rarely. Their transaction costs over a lifetime are negligible. But the even bigger cost is taxes. In the United States, when you sell a winning investment that you've held for less than a year, the profit is taxed as ordinary income at your highest marginal tax rate. If you hold it for more than a year, it's taxed at the much lower long-term capital gains rate. The punch card investor who aims to hold businesses for decades almost never pays that punitive short-term rate. They let their investments compound year after year, tax-deferred. The government only gets its share when the stock is finally sold, perhaps 30 or 40 years down the line. This tax deferral is like an interest-free loan from the government, supercharging your compounding machine. The financial difference is staggering. A portfolio that is churned annually, realizing gains and paying taxes along the way, will end up being worth a fraction of an identical portfolio that is simply left untouched. The punch card mentality isn't just a philosophy, it's a superior financial technology for building wealth, maximizing the impact of your best decisions, while minimizing the frictional costs that bleed the average investor dry. The second great pillar in the temple of strategic inaction is the ruthless identification and conquest of what is known as the fallacy of action. This is the deep, primal, and often financially fatal urge to do something. Our brains are not wired for the modern stock market, they are wired for the savannah. For millennia, our survival depended on quick reactions. If you heard a rustle in the grass, the person who immediately acted, by running or throwing a spear, was more likely to survive than the person who sat still and analyzed the situation. Action was synonymous with survival. Inaction was synonymous with death. This evolutionary hangover is now one of the greatest impediments to successful long-term investing. When the market rustles, when prices start to fall, every instinct in our body screams at us to act. Sell, change something, do something. Anything is better than just sitting here and watching my net worth decline. This deeply ingrained action bias is the enemy of returns. It's the voice in your head that whispers, "The market is down 500 points, you can't just sit there." It's the feeling of unease that comes from a portfolio that hasn't been tinkered with in a few months. It's the pressure to chase the hot.com stock in 1999, or the hot crypto token today, because everyone else is getting rich, and you're just sitting on your boring blue-chip stocks. Buffett's genius is his almost supernatural ability to override this impulse. He understands that in investing, your primary job is often to fight the urge to act. He famously said, "The stock market is a device for transferring money from the active to the patient." This pillar is about understanding that activity is not only unnecessary, but is often the very thing that destroys your path to financial freedom. It is about building the psychological armor necessary to sit still in a world that is screaming at you to move. It is about learning that the most profitable action you can often take is no action at all. A perfect foundational anecdote for this principle, for overcoming the urge to meddle, is Buffett's 1972 purchase of See's Candies. This story is crucial because it isn't about a stock, it's about buying an entire business. And it taught Buffett and his partner Charlie Munger one of the most important lessons of their careers: the power of a high-quality business to do the heavy lifting for you, provided you have the discipline to get out of its way. At the time, Buffett and Munger were still primarily disciples of Ben Graham's cigar butt investing, finding deeply undervalued, often mediocre companies for a cheap price. See's Candies was different. It was not statistically cheap. The See family wanted $30 million for the company, while its tangible assets, its book value, were only around $8 million. To a traditional value investor, this was heresy. You were paying a massive premium for intangible things like brand and customer loyalty. Munger, however, pushed Buffett to see the bigger picture. He saw a business with a powerful moat. See's had immense pricing power. They could raise the price of their boxed chocolates every year, and devoted customers in California would happily pay it. It was a regional icon, with a fanatically loyal customer base. It was, in short, a wonderful business. They ultimately negotiated the price down to $25 million and bought the company. And here is where the lesson in inaction begins. Having bought this jewel of a business, the temptation for many executives or private equity firms would be to do something to justify their purchase. They would launch a massive expansion plan to take See's national. They would re-engineer the candy-making process to cut costs. They would change the packaging, launch new product lines, and meddle with the formula that had made the company successful for 50 years. They would feel the pressure to add their value. Buffett and Munger did the opposite. They recognized that the magic of See's was already in place. Their job was not to fix it, but to not break it. They left the existing management team led by the incredible Chuck Huggins in charge. They didn't move the headquarters from California to Omaha. They didn't interfere with the recipes or the store layouts. They did essentially nothing. They simply provided the capital and the oversight and let this wonderful business continue to be a wonderful business. They allowed the brand loyalty, the pricing power, and the smart management to work their magic year after year. The results were astounding. That initial $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all of which was sent back to Omaha for Buffett to reinvest in other ventures. It became the prototype for the kind of business Berkshire would seek to acquire for the next 50 years. The See's Candy story is the ultimate testament to fighting the action bias. It demonstrates that when you own a truly high-quality asset, your primary job is not to constantly tinker and optimize, but to have the wisdom and patience to let its inherent qualities compound over time. The value they added was in their initial decision to buy a great business and their subsequent decision to do nothing to mess it up. For the stock market investor, the lesson is identical. When you identify and purchase a stake in a great company, a Coca-Cola, an Apple, a Microsoft, your work is largely done. The constant urge to trade it, to trim it, to take profits, is the same destructive impulse that would have ruined See's Candies. True portfolio management often means portfolio neglect. You let the exceptional managers and durable competitive advantages of the companies you own do the work for you. Your activity is the enemy of their success. The underlying psychological principle that makes us such terrible proponents of inaction is the powerful and pervasive action bias. This is our innate, often irrational preference for action over inaction. Psychologists have demonstrated this bias in numerous fields, but it is perhaps most visible and costly in the world of finance. A famous study looked at the behavior of professional soccer goalkeepers during penalty kicks. The data showed that a goalkeeper's optimal strategy is to stay in the center of the goal. Statistically, they have the highest probability of making a save by not moving at all. Yet, in over 94% of penalty kicks, goalkeepers dive to the left or to the right. Why? Because the social and personal cost of conceding a goal while standing still feels far worse than conceding a goal while diving heroically, even if you dive the wrong way. The appearance of effort, of doing something, is valued more than the statistically superior choice of doing nothing. This is the exact same mental glitch that afflicts investors. When the market is crashing, the emotional pain of watching your portfolio decline while doing nothing feels unbearable. Selling, even at a loss, provides a sense of agency and control. It feels like you are doing something to stop the bleeding. It's the financial equivalent of the goalkeeper diving. You are taking an action that feels correct but is often statistically the worst possible decision, as market bottoms are historically followed by sharp, unpredictable rebounds that are missed by those on the sidelines. The action bias is fueled by several other cognitive shortcuts. One is the illusion of control, the tendency for people to overestimate their ability to control events. An active trader believes their research, their chart reading, or their timing strategy gives them an edge. They believe their actions can influence the outcome, when in reality, they are often just reacting to random noise. Another fuel source is social pressure and regret aversion. When everyone around you is panicking and selling, or euphorically buying a meme stock, the pressure to conform is immense. We are herd animals. The fear of being left behind, if a stock is soaring, or the fear of looking foolish by holding on during a crash, regret, are powerful motivators for action. The financial media industry is a giant 24/7 machine designed to stoke this action bias. Every headline, every breaking news alert, every market in turmoil segment is designed to make you feel that you must act now. Their business model depends on eyeballs and trading volume, both of which are driven by a sense of urgency and a need for constant activity. Understanding the action bias is the first step toward conquering it. You must recognize that the intense urge you feel to tinker with your portfolio during times of stress or excitement is not a rational signal from a well-calibrated financial mind. It is a primitive, evolutionary echo from the savannah, amplified by a modern media machine. A successful long-term investor is not someone who has better information. They are someone who has better control over these impulses. They have learned to value the statistically superior, emotionally difficult choice, often to do nothing at all. They have achieved a level of financial education that allows them to be the goalkeeper who calmly stands in the center, knowing that it's their best chance for success, even if it looks passive to the screaming crowd. To operationalize this fight against our own worst instincts, we need an applied mental model. I call it the inversion and inaction framework. It's a two-step process designed to create a psychological circuit breaker between an event in the market and your decision to act. It forces you to pause, think differently, and make inaction your default setting. The first step is inversion. The practice of inversion, championed by Buffett's partner Charlie Munger, means approaching a problem backward. Instead of asking what should I do, you ask what should I not do? Or what would the average, panicky, uninformed person do in this situation, and how can I avoid it? So, when the market experiences a sharp downturn, the inversion process begins. The average person, driven by action bias and fear, is thinking, I need to sell to protect what I have left. I need to get out before it goes to zero. They are focused on the immediate pain and the downward momentum. Inverting this means asking, what is the stupidest thing I could do right now? The answer is almost always, sell a wonderful long-term holding at a temporary low price, turning a paper loss into a permanent one, and missing the eventual recovery. By simply inverting the problem, you immediately reframe the situation. You are no longer thinking about how to react to the panic. You are thinking about how to avoid the single most destructive mistake. The second step is creating an inaction default. Our lives are governed by defaults. The default on your phone's browser, the default radio station in your car. We tend to stick with the path of least resistance. For most investors, the default is to check their portfolio constantly, which invites the temptation to act. The inaction default seeks to change this. First, you must architect your environment to reduce triggers. Delete the stock market app from your phone's home screen. Unsubscribe from breaking financial news alerts. Set a rule that you are only allowed to look at your portfolio once a month, or even once a quarter. This creates friction and makes it harder to act impulsively. Second, you create an if-then inaction plan. You write it down in advance, during a moment of calm. For example, if the market drops by more than 20%, then I will do absolutely nothing for at least 30 days. I will not sell a single share. After 30 days, I will only review my portfolio to see if any of my wonderful businesses have become even cheaper and are now a candidate to buy more of. This pre-commitment is incredibly powerful. When the crisis hits, you don't have to think. You just have to execute your pre-planned inaction. You've made the rational decision for your future, emotional self. The inversion and inaction framework is a system for overriding your primitive brain. Inversion helps you identify the most common and costly mistakes, and the inaction default builds a system to ensure you don't make them. It transforms you from a leaf blown about by the winds of market sentiment into an oak tree, rooted in a disciplined process. It's not about being smarter than everyone else. It's about being more disciplined. This disciplined approach to portfolio management is what separates amateurs from professionals and is a crucial component of any sound plan for building wealth. The antithesis of this calm, disciplined inaction is the chaotic and seductive world of the day trader. This is the ultimate manifestation of the action bias, the path of the 99% on steroids. The day trader's delusion is the belief that one can consistently profit from the small, intraday fluctuations of stock prices. It's a world fueled by caffeine, adrenaline, and the alluring promise of quick riches. Let's paint a picture of this life. The day trader wakes up before the market opens. They are not reading annual reports or studying business models. They are scanning pre-market movers, analyzing candlestick charts, and looking for patterns. Head and shoulders, golden crosses, death crosses. Their screen is a dizzying array of flashing numbers, lines, and graphs. They are not an investor. They are a hunter, looking for fleeting opportunities in the digital noise. The market opens, and the game begins. Their heart rate quickens. They see a stock spike on high volume. Is this the breakout? They jump in, buying 1,000 shares. A few minutes later, the stock reverses. Their small gain turns into a small loss. Their stomach tightens. Should they cut the loss, or will it bounce back? The emotional roller coaster is relentless. They sell for a small loss. Then, they see another opportunity. They jump in again. This one works out. They make a quick profit and feel a rush of euphoria. They are a genius. This is easy. They spend the entire day glued to the screen, riding this wave of fear and greed, making dozens of trades. At the end of the day, they tally up their results. After commissions and fees, they might be up a little, down a little, or flat. But they are mentally and emotionally exhausted. This is not investing. It is high-stakes, high-stress gambling disguised as a profession. The statistics on the success of day traders are abysmal. Study after study has shown that the vast majority, upwards of 95%, lose money over the long term. They are systematically transferring their wealth to their brokers through commissions and to the long-term investors who are patiently holding the very stocks they are frantically trading. Why do so many people fall for this delusion? It plays directly into our most powerful cognitive biases. It feeds the action bias, making them feel productive and in control. It provides intermittent reinforcement, like a slot machine. The occasional winning trade delivers a dopamine hit that keeps them coming back, forgetting the multitude of losses. It is the purest form of trading versus investing. They are focused solely on the price of the stock, not the value of the underlying business. A day trader doesn't care about a company's return on equity or its competitive moat. They only care where the price will be in the next 5 minutes. This short-term focus is the polar opposite of the patient, business owner mindset required for building real wealth. The day trader is the goalkeeper who is not just diving on every penalty kick, but is constantly jumping back and forth between the goalposts, even when there is no kick. Their constant motion is a spectacle of wasted energy and financial self-harm. It is the ultimate costly market mistake, a path that promises financial freedom but delivers, for almost everyone who walks it, only stress and a depleted brokerage account. The direct financial connection between overcoming the action bias and your net worth can be quantified by a concept known as the behavior gap. This is one of the most important and tragic realities in personal finance. The behavior gap is the difference between the returns that an investment time generates, tames, and the returns that an investor timed actually receives. For decades, research firms like Dalbar have published studies showing that this gap is enormous. For example, over a 20-year period, an investment fund might have an average annual return of 10%, but the average investor in that same fund might only have a return of 7%. That 3% difference, the behavior gap, is the direct financial cost of ill-timed activity. Where does that 3% go? It is lost forever. It is the wealth that was destroyed by the investor's own actions, buying high during periods of euphoria and selling low during periods of panic. It is the financial manifestation of the action bias. Let's put this into concrete numbers to understand the devastating impact. Imagine two investors, Patient Paul and Active Andy, both start with $100,000. They both invest in the same index fund that returns an average of 10% per year over 30 years. Patient Paul, who has mastered the art of inaction, simply buys the fund and does nothing else. He lets it ride through all the ups and downs. His $100,000, compounding at 10% for 30 years, grows to approximately $745,000. He has achieved true financial freedom. Active Andy, on the other hand, is a victim of the action bias. He tries to time the market. He gets scared during crashes and sells, then gets excited during rallies and buys back in. His poorly timed moves create a 3% behavior gap. His average annual return is only 7%. After 30 years, his initial $100,000 has grown to approximately $761,000. That is a difference of nearly $1 million. $1 million. It's the same initial capital, the same investment vehicle, the same time horizon. The only difference was behavior. Active Andy's constant doing something cost him a fortune. This isn't a hypothetical scenario. It is the statistical reality for millions of retail investors. The behavior gap is the ultimate tax on activity. It is the direct financial reward you pay yourself for cultivating the discipline of patience. Every time you feel the urge to act and you consciously choose not to, you are actively defending your portfolio from its single greatest threat, yourself. By simply closing the behavior gap, by learning to sit still and let your investments do their work, you can dramatically outperform the vast majority of other market participants without any special stock-picking skill. Your inactivity becomes your alpha. It is the purest, most direct way that doing nothing translates into a massive, tangible financial advantage, creating the kind of generational wealth that active traders can only dream of. This brings us to the mathematical heart of our entire philosophy, the engine that drives the creation of all great fortunes. This is the third pillar, the compounding engine. Albert Einstein is often apocryphally credited with calling compound interest the eighth wonder of the world, adding, "He who understands it, earns it. He who doesn't, pays it." Whether he said it or not, the statement is profoundly true. Compounding is the process where the earnings from an asset, from either capital gains or interest, are reinvested to generate additional earnings over time. It is a snowball effect. In the beginning, the growth is slow, almost imperceptible, but over long periods, the process becomes explosive, with the growth curve turning nearly vertical. The mistake most people make is that they grasp the concept of compounding intellectually, but they lack the patience to experience its true power. They interrupt the process. Buying a great business is only the first step. The real magic, the source of life-changing wealth, comes from holding that business long enough for the compounding engine to engage its warp drive. This pillar is not just about buying and holding. It's about buying and holding on for dear life. It's about letting your winners run, not for a year, but for a decade, or a lifetime. The constant temptation is to lock in profits on a stock that has doubled or tripled. It feels smart. It feels prudent. But in doing so, you are often cutting down an oak tree when it is still a sapling. You are selling your best assets and interrupting the single most powerful force for wealth creation on the planet. Buffett's great secret is his partnership with time. He allows the internal compounding of his businesses, the reinvestment of their own profits into new growth, to be mirrored by the external compounding of his investment in their stock. He understands that the biggest gains don't come in year 1 or year 5, they come in year 20 and year 30. This is the ultimate test of an investor's discipline, the ability to sit still and let the eighth wonder of the world do its work. The quintessential story of the compounding engine, the foundational anecdote that every investor should tattoo on their brain, is Warren Buffett's investment in the Coca-Cola Company. It is the single greatest example of how a brilliant initial decision, followed by decades of resolute inaction, can produce a result so staggering it almost defies belief. The year was 1988. The stock market was still reeling from the Black Monday crash of October 1987, when the Dow Jones Industrial Average fell by over 22% in a single day. Fear was still thick in the air. Buffett, however, was quietly and methodically building one of the largest positions of his career. He saw Coca-Cola not as a stock, but as a global institution. He saw a business with a product that was cheap, universally desired, and associated with happiness. It had a brand that was arguably the most powerful in the world, a moat that was less like a ditch and more like an ocean. The company was a cash-generating machine, and it was available at a reasonable price. Between 1988 and 1989, Berkshire Hathaway invested $1.02 billion to purchase a massive stake in Coca-Cola. At the time, this was a huge bet. Even for Buffett, it was a significant portion of Berkshire's portfolio. He had made his punch-card decision with immense conviction. And then came the masterstroke. For the next 3 decades and beyond, he did almost nothing. He just held. Let's trace the journey of this compounding engine. By 1997, less than a decade later, Berkshire's position in Coca-Cola was worth over $13 billion. An incredible return. Many investors, having made 13 times their money, would have felt an overwhelming urge to sell and lock in those gains. The action bias would have been screaming at them. They would have patted themselves on the back for a brilliant trade. But Buffett understood he was not a trader, he was an owner. And the compounding engine was just warming up. He held on. What happened next is where the story becomes truly legendary. Coca-Cola continued to grow its earnings and, crucially, its dividend. The dividend is the portion of a company's profits that it pays out to its shareholders. When Buffett first invested, the annual dividend he received from Coca-Cola was about $75 million. A nice sum, but nothing compared to what was to come. As the years rolled by, Coca-Cola consistently increased its dividend payout. By 2022, the annual dividend Berkshire Hathaway received from its Coca-Cola stock had grown to $704 million. Let that sink in. He was now receiving over 70% of his original investment back every single year in cash dividends alone, without selling a single share. This concept is called yield on cost, and it is the secret reward for the ultra-long-term investor. While a new buyer of Coke stock in 2022 might get a dividend yield of around 3%, Buffett's yield on his original cost was over 50%. The stock itself had also appreciated enormously, making his initial $1 billion stake worth well over $20 billion. The Coca-Cola saga is the perfect illustration of letting your winners run. The vast majority of the gains came not from the initial pop, but from the slow, relentless, quiet work of compounding over decades. It required him to sit through recessions, market crashes, changes in consumer tastes, and endless news cycles predicting the company's demise. His decision to do nothing, to not interrupt the process, created tens of billions of dollars in value. It is the ultimate proof that the most powerful tool in wealth management is not a complex algorithm, but a simple calendar, combined with the psychological fortitude to let it do its work. The psychological principle that constantly works against our ability to harness compounding is a potent cognitive bias called hyperbolic discounting. This is our brain's tendency to have a stronger preference for smaller, immediate rewards over larger, later rewards. The discounting is the way our mind devalues a future reward. The hyperbolic part refers to the fact that this devaluation is not linear. The rate at which we devalue the future is steepest in the short term. In simple terms, your brain finds it very difficult to appreciate the value of a huge reward in 20 years compared to a small, tangible reward right now. This is why so many people struggle with saving for retirement, sticking to a diet, or quitting smoking. The immediate pleasure of spending the money, eating the cake, or having the cigarette overwhelms the abstract, distant promise of a healthier or wealthier future. In investing, hyperbolic discounting is a wealth-destroying machine. It is the voice in your head that says, "Your stock has doubled. You've made $10,000. Sell it now. Lock in that profit. You can take a vacation, buy a new TV. That future gain in 20 years is just a fantasy. This $10,000 is real, right here, right now." The immediate, certain reward of the realized gain is far more emotionally compelling than the larger, uncertain, and distant reward of long-term compounding. When you sell a winning stock to lock in a profit, you are satisfying your brain's craving for immediate gratification. You get a dopamine hit from seeing the realized gain in your account. You have avoided the potential regret of that stock going down and giving back your profits. You feel smart and in control. What you cannot feel, what your brain is not wired to appreciate, is the immense opportunity cost of that decision. You have just shot your golden goose. you have interrupted the single most powerful force for building wealth. That $10,000 stock that could have become $200,000 over the next 2 decades is now gone, and the process has to start all over again from scratch with a new investment. Overcoming hyperbolic discounting requires a conscious and deliberate shift in your time horizon. It requires moving from thinking like a trader who is focused on today's price to thinking like a business owner who is focused on the value the business will create over the next generation. It also requires an act of faith in the mathematics of compounding. You have to trust the process, even when your emotional brain is screaming for the immediate reward. This is why having a deep understanding of the businesses you own is so critical. If you see your stock not as a flickering ticker but as a share in a cash-gushing enterprise like See's Candies or Coca-Cola, it becomes easier to resist the temptation to sell. You are no longer trading a piece of paper. You are holding a piece of a compounding machine. Recognizing that the urge to sell a winner early is a cognitive bias, not a rational financial strategy, is the key to letting the eighth wonder of the world build your fortune. It is the mental hurdle every investor must clear to move from making money to building true, lasting wealth. To combat hyperbolic discounting and fully engage the compounding engine, we need an applied mental model that forces a long-term perspective. This blueprint is called the 10-year test. It is a simple but profoundly effective exercise that must be completed before you are allowed to purchase any investment. It fundamentally changes the criteria for your decisions, shifting the focus from short-term price action to long-term business performance, which is the true fuel of compounding. Here is the step-by-step process. Before you buy a single share of a company, you must take out a piece of paper or open a blank document, and you must answer one question in writing, with a minimum of 500 words. Why would I be thrilled to own this business if the stock market were to close for the next 10 years? This question is a powerful filter. It immediately renders all short-term considerations irrelevant. Technical analysis, quarterly earnings whispers, recent analyst upgrades, market sentiment, all of it becomes meaningless noise. You cannot rely on being able to sell the stock next week or next month, so you are forced to evaluate the investment on its own merits, as a standalone business. To answer the question properly, you must address several sub-questions. First, what is the company's durable competitive advantage? How, specifically, will this business defend itself against competitors for the next decade? Is it a powerful brand like Coca-Cola? Is it a network effect like Facebook or Visa? Is it a low-cost production advantage like Geico? You must be able to articulate this moat in simple, clear language. Second, what will be the primary driver of earnings growth over the next 10 years? Will they be expanding into new geographic markets? Are they launching new, innovative products? Are they benefiting from a long-term demographic or technological trend? You need a clear and plausible story for how the business's profits will be higher in a decade than they are today. Third, how does the management team allocate capital? This is crucial. A business generates cash. What does the leadership do with it? Do they reinvest it wisely into high-return projects? Do they buy back their own stock when it's cheap? Do they pay a growing dividend? Or do they squander it on foolish value-destroying acquisitions? You must look at their track record to predict their future behavior. You are, in effect, hiring this management team to be your partners for the next decade. You must be confident in their skill and integrity. Writing out the answers to these questions forces a level of deep thinking that is completely absent from the typical investment process. It transforms you from a stock renter into a business owner. Once you have completed this 10-year test document, it serves two purposes. First, it is your final filter before buying. If you cannot write a compelling 500-word essay, you are not allowed to buy the stock, period. It has failed the test. Second, this document becomes your touchstone during periods of market turmoil. When the stock drops 30% and your emotional brain is screaming sell, you don't look at the stock price, you reread your 10-year test document. You ask yourself, has anything in this long-term thesis fundamentally changed? In most cases, the answer will be no. The market is just having one of its temporary fits. Your document becomes your anchor of rationality in a sea of emotion, allowing you to hold on and let the compounding engine do its miraculous work. This is the practical tool for achieving the financial education necessary for long-term investing success. The antithesis to letting your winners compound is a disastrous but tragically common behavior pattern that Peter Lynch so brilliantly described as cutting the flowers and watering the weeds. This single phrase perfectly captures the self-destructive tendencies of the average investor, and it is the fastest way to guarantee a portfolio of mediocrity. Imagine a gardener. In one part of the garden, they have beautiful, vibrant, healthy roses that are growing strong and blooming magnificently. In another part, they have a patch of scraggly, yellowing weeds that are barely clinging to life. What would a rational gardener do? They would, of course, provide more water and fertilizer to the magnificent roses to help them grow even stronger, and they would ruthlessly pull out the weeds to stop them from sucking up nutrients from the soil. Now, consider the average investor's portfolio. They have a few flowers, stocks of wonderful, growing companies that have performed exceptionally well, and they have a handful of weeds, stocks of struggling, mediocre companies that have declined in value since they were purchased. What does the investor driven by cognitive biases do? The exact opposite of the gardener. They look at their winning stock, the flower, and think, "Wow, I've doubled my money. I can't lose this profit, I should sell it and lock it in." So they cut their flower. Then they look at their losing stock, the weed, and think, "I can't sell it now, I'd be taking a loss. I'll just hold on until it gets back to what I paid for it." So they water their weed. Over time, what is the inevitable result of this process? The investor systematically eliminates all of their best-performing assets and accumulates a portfolio composed entirely of their worst ideas. Their garden becomes nothing but weeds. This behavior is driven by a collection of psychological demons. The decision to sell the winner is fueled by regret aversion and hyperbolic discounting, the fear of the stock going down and the desire for an immediate profit. The decision to hold the loser is driven by loss aversion. The pain of realizing a loss is psychologically about twice as powerful as the pleasure of realizing an equivalent gain, and the endowment effect, where we overvalue something simply because we own it. They get emotionally attached to their losing positions, hoping and praying for a comeback that often never materializes. This is the ultimate interruption of the compounding process. The stocks that are capable of becoming 10-baggers or 100-baggers, the Coca-Colas of the world, are sold after they have merely doubled. The capital is then tied up for years in stagnant, underperforming businesses. It's a strategy that is perfectly designed to produce poor results. A professional investor, a true practitioner of long-term investing, does the precise opposite. They periodically review their portfolio and consider trimming their worst-performing businesses, pulling the weeds, to add more capital to their highest conviction, best-performing businesses, watering the flowers. This is what Charlie Munger means when he talks about finding the few great companies and then betting heavily on them. It requires the emotional discipline to admit when you've made a mistake and cut a loser, and the foresight to let a wonderful business continue its incredible run. The path of the 99% is to create a garden of failure, one irrational decision at a time. The path to wealth is to cultivate your flowers and be a ruthless weeder. The direct financial connection of harnessing the compounding engine is the most dramatic and visually stunning concept in all of finance. It is the source of the hockey stick growth chart that defines every great fortune. Interrupting this process, even for a short time, has a financial consequence that is almost too large to be believed. Let's do the math and make this tangible. Consider a single $10,000 investment in a high-quality business that is able to compound its value at an average rate of 15% per year. We will compare two scenarios over a 40-year investment horizon, the typical time frame from starting a career to retirement. Scenario A is the patient owner. This investor makes the single $10,000 investment and then does absolutely nothing for 40 years. They never sell, they never trade, they let the flower grow. The math is straightforward. $10,000 compounding at 15% for 40 years grows to a staggering $2, $678, $635. From a single $10,000 decision, they have built generational wealth. Scenario B is the active trader. This investor also finds a business that grows at 15% per year, but they are driven by the biases we've discussed. Every time the stock doubles, they sell it to lock in the profit, and then, let's be generous, they manage to find another similar investment immediately. A stock growing at 15% will double roughly every 5 years, so over the 40-year period, this investor will interrupt the compounding process 8 times. Each time they sell, they have to pay long-term capital gains tax. Let's assume a 15% federal tax rate. After the first 5 years, their $10,000 has grown to $20, 113. They sell. They pay a 15% tax on the $10, 113 profit, which is $1, 517. They are left with $18, 596 to reinvest. They repeat this process every 5 years. After 40 years of being smart and prudent by constantly locking in their gains, what is their final portfolio value? It's approximately $693,000. Look at those two numbers. Investor A, who did nothing, has over $2.6 million. Investor B, who was active and diligent, has less than $700,000. The active trader's constant meddling cost them nearly $2 million. This is the catastrophic hidden tax on activity. And our scenario was generous. It assumed the trader could consistently find new 15% compounding businesses and didn't include state taxes or the risk of being out of the market and missing a rebound. In reality, the outcome for the active trader is usually far worse. This mathematical reality is the foundation of building wealth through buy and hold investing. The bulk of your returns do not come from your brilliant insights in year 1. They come from the exponential growth that occurs in years 20, 30, and 40. Compounding is a force of nature, like gravity. You can either align yourself with it and let it lift you to incredible heights, or you can fight against it, interrupting it with constant activity, and remain forever grounded in mediocrity. The choice is yours, and the financial stakes could not be higher. We arrive now at the 4th pillar, which serves as the psychological shield that makes this entire strategy of inaction possible. It is the great defense against the daily onslaught of noise, fear, and greed that emanates from the market. This pillar is the dual concept of Mr. Market and the margin of safety. These ideas, inherited by Buffett from his mentor, Benjamin Graham, are the bedrock of value investing. They are not complex formulas, but powerful allegories and principles that, once internalized, allow an investor to remain calm and rational while everyone else is losing their minds. First, Mr. Market. Graham asked his students to imagine that they are business partners with a man named Mr. Market. Every day, Mr. Market shows up at your door and offers to either buy your shares in the business or sell you his at a specific price. The crucial thing to understand about Mr. Market is that he is a manic depressive. Some days, he is euphoric. He sees only a bright future for the business and offers you a ridiculously high price for your shares. Other days, he is inconsolably pessimistic. He sees nothing but trouble ahead and, in a panic, offers to sell you his shares at a ludicrously low price. Mr. Market is there to serve you, not to guide you. You are free to ignore him completely. You should not be influenced by his mood swings. You should only transact with him when his emotional state presents you with an opportunity. You sell to him when he is ecstatic, and you buy from him when he is suicidal. Most of the time, you do nothing. You simply thank him for the quote and close the door. This allegory is a brilliant personification of the stock market itself. The daily fluctuations are not a reflection of the true underlying value of your business. They are a reflection of the mob's emotional state. By externalizing the market into this erratic character, you can psychologically detach from its movements. The second concept, the margin of safety, is the practical tool that gives you the confidence to ignore Mr. Market's pessimism. A margin of safety means purchasing an asset for a price significantly below your conservative calculation of its intrinsic value. If you calculate that a business is worth $1 per share, you don't buy it at 95 cents. You wait patiently until Mr. Market, in one of his depressive fits, offers it to you for 50 cents. That 50-cent gap is your margin of safety. It is your buffer against bad luck, errors in your own judgment, or unforeseen problems in the business world. It is the shock absorber that protects your capital. Together, these two concepts form an impenetrable defense. Mr. Market provides the opportunities, and the margin of safety tells you when to act. For the investor committed to inaction, this framework is essential. It gives you a rational basis for ignoring the daily noise. You don't need to act because you know the true value of your business, and you bought it at a price that provides a massive cushion. The market's daily tantrums become a source of amusement and opportunity, not a source of anxiety and fear. The foundational anecdote that perfectly captures the use of Mr. Market and the margin of safety is Buffett's 1973 investment in the Washington Post Company. This was not just a great investment, it was a defiant act of rationality in the face of overwhelming market pessimism. The early 1970s were a difficult time for the stock market, a period known as the Nifty 50 bubble collapsing. The market had previously been obsessed with a group of 50 large, one-decision growth stocks that investors believed could be bought at any price. When that bubble burst, the entire market was dragged down with it, and the mood on Wall Street turned from euphoria to despair. The Washington Post, despite being a high-quality, iconic media institution fresh off its triumphant Watergate reporting, was caught in this downdraft. The stock was universally hated. The market saw newspapers as a dying industry. It saw the company as being controlled by the Graham family, which might not always act in the interest of minority shareholders. Mr. Market was not just pessimistic. He was clinically depressed about the future of the Washington Post. He was offering to sell shares at a price that valued the entire company at just $80 million. This is where Buffett, the dispassionate analyst, went to work. He ignored Mr. Market's emotional state and focused on calculating the intrinsic value of the business. What did the Washington Post Company actually own? It owned the flagship newspaper, of course. But it also owned Newsweek magazine, several television stations, and other media properties. Buffett analyzed each of these assets separately. He conservatively estimated that the television stations alone were worth more than the entire $80 million price tag the market was placing on the company. The newspaper, Newsweek, and everything else he was getting for free. This was a textbook margin of safety. He calculated the business was worth at least $400 million, maybe $500 million. And Mr. Market, in his profound depression, was offering to sell it to him for $80 million. He was being offered a dollar bill for 20 cents. So, over the course of 1973, Buffett calmly began buying shares, eventually investing about $10.5 million to acquire a large stake in the company. He was buying when there was blood in the streets. He was taking advantage of Mr. Market's suicidal mood. The Wall Street establishment thought he was crazy. But Buffett wasn't listening to Wall Street, he was listening to his own analysis. And then, having made his purchase with an enormous margin of safety, he did what he does best: he held. He sat patiently for years. He joined the company's board, offering his counsel to Katharine Graham, the brilliant CEO. He didn't trade the stock. He simply let the value of the underlying businesses grow and waited for Mr. Market's mood to inevitably swing back from depression to sanity, and eventually to euphoria. That $10.5 million investment would, over the next 3 decades, grow to be worth more than $1 billion. It became one of the cornerstones of Berkshire Hathaway's success. The story of the Washington Post is the perfect operational manual for this pillar. You use the ravings of the manic-depressive Mr. Market to identify opportunities. You use a cold, hard, conservative calculation of intrinsic value to ensure a massive margin of safety. And that margin of safety gives you the supreme confidence required to do nothing, to sit still for years while the value of your asset inevitably rises to meet its true worth. The psychological principles that Mr. Market and the margin of safety are designed to counteract are two of the most powerful herding instincts we possess: herd mentality and recency bias. Herd mentality, also known as herd behavior, is the tendency for individuals to mimic the actions of a larger group. In nature, this is a survival mechanism. The antelope that runs with the herd when a lion appears is more likely to survive than the one that stands alone. In the stock market, this instinct is financially lethal. When the market is soaring, the herd is buying. The fear of missing out, FOMO, becomes overwhelming. Seeing friends and neighbors get rich creates immense social pressure to join in, often at the peak of a bubble. Conversely, when the market is crashing, the herd is selling. The fear and panic are contagious. Seeing everyone else rush for the exits triggers a primal fear of being the last one left holding the bag. Mr. Market is the personification of this herd. His euphoric quotes are the siren song of the bubble. His panicked quotes are the terrified screams of the crash. The allegory of Mr. Market works by creating a psychological separation between you and the herd. By framing the market's price as the opinion of a single, unreliable, emotional individual, it depersonalizes the herd's pressure. You are no longer fighting against the wisdom of the crowd. You are simply declining a bad offer from a crazy man. This reframing allows you to think independently and act counter-cyclically, which is the hallmark of every great investor. The second principle is recency bias. This is our tendency to overweight recent events and to project them indefinitely into the future. When the market has been going up for 3 years, our brain starts to believe that it will continue to go up forever. When it has been going down for 6 months, our brain assumes it is heading for zero. Recency bias makes us terrible forecasters. It's what makes investors pile into tech stocks at the peak of the dot-com bubble and swear off stocks forever at the bottom of the 2008 financial crisis. The margin of safety is the ultimate antidote to recency bias. It anchors your decision-making not in the recent performance of the stock price, but in the timeless, conservative valuation of the underlying business. Your calculation of intrinsic value is based on a decade of financial data and a conservative projection of future cash flows. It is a stable, rational anchor in a sea of short-term emotion. When recency bias is screaming that the world is ending because the market is down 20%, your margin of safety calculation calmly reminds you that you own a wonderful business that is now 20% cheaper than it was before. It allows you to see the panic not as a threat, but as an opportunity to increase your margin of safety even further. By understanding these deep-seated biases, we can appreciate the genius of Graham's framework. It is a complete psychological operating system for the value investor. Mr. Market helps you diagnose and ignore the madness of the herd, while the margin of safety provides the rational, analytical foundation that makes you immune to the short-sightedness of recency bias. Together they give you the power to stand apart, to remain patient, and to act only when the odds are overwhelmingly in your favor. To put this defensive framework into practice, the retail investor can use a simple but powerful applied mental model I call the price versus value ledger. This is a practical exercise, a written document that you maintain for each of your core long-term holdings. It serves as a constant, visual reminder of the difference between Mr. Market's opinion and your own analytical judgment, creating a formidable barrier against emotional decision-making. Here's how you build and use it. For each stock you own, you create a simple 2-column ledger. You can do this in a notebook or a spreadsheet. The left column is titled Price, Mr. Market's daily quote. The right column is titled Value, my business appraisal. In the left price column, you can, if you choose, update the stock's current price once a week or once a month. This column represents the manic-depressive mood swings of your business partner, Mr. Market. It will be volatile, fluctuating with the news of the day. The key is to view this number not as a measure of your success or failure, but simply as an offer on the table from your erratic partner. In the right value column, you write down your conservative estimate of the company's intrinsic value per share. This is the number you derived from your deep research, from your 10-year test, and your discounted cash flow analysis. This number is not to be changed lightly. You only update your value estimate when a fundamental, long-term fact about the business changes. For example, if the company makes a brilliant acquisition that will significantly increase future cash flows, you might raise your value estimate. If a new competitor emerges that seriously threatens their competitive moat, you might lower it. but you never change your value estimate simply because the price has changed. This ledger creates a powerful psychological disconnect. On a single page, you have two numbers. One is the emotional, flighty, daily opinion of the crowd. The other is your own reasoned, well-researched, stable judgment of worth. The entire goal of this exercise is to train your brain to focus on the right-hand column. When Mr. Market is in a panic, and the price column drops 30% below the value column, your ledger doesn't signal fear, it signals opportunity. It visually displays a massive margin of safety. Conversely, when Mr. Market is euphoric and the price column soars to double the value column, your ledger doesn't signal genius, it signals danger and perhaps a time to consider selling to your over-enthusiastic partner. Using the price versus value ledger is a form of active meditation for the investor. It forces you to reaffirm your own research and your own conclusions in the face of market chaos. It makes it nearly impossible to fall into the trap of equating price with value. It is the practical implementation of Graham's teaching, a tool that allows you to smile at Mr. Market's antics, secure in the knowledge of what your business is truly worth, giving you the unshakable confidence needed for a successful buy and hold strategy. The antithesis of this rational, detached approach is the headline chaser. This is the investor whose every move is a direct reaction to the financial news cycle. They have effectively outsourced their decision-making process to the whims of the media and the emotions of the crowd. They have made Mr. Market not their servant, but their master. The headline chaser's day starts with CNBC on the television in the background. They see a segment about a new technology that's changing the world. An analyst comes on, pounding the table, calling a certain stock a strong buy. The headline chaser, gripped by the fear of missing out, immediately logs into their brokerage account and buys the stock, without any independent research or valuation work. They are buying at the peak of excitement, likely when the price is already inflated. Later that day, a breaking news alert flashes across the screen. Fed hints at faster rate hikes, markets tumble. Fear grips them. The talking heads are using words like turmoil, uncertainty, and recession. The headline chaser looks at their portfolio, which is now a sea of red. Their stomach churns. They can't take the pain. They sell their holdings, wanting to go to cash until things are more certain. They have just sold into a panic, locking in their losses. This investor is in a constant state of whiplash. They are perpetually buying what is popular and expensive and selling what is unpopular and cheap. They are the person who bought .com stocks in 1999 and sold them in 2001. They are the person who bought housing stocks in 2006 and sold them in 2008. They are the person who bought Peloton in 2021 and sold it in 2022. They are not executing a strategy, they are merely reacting to stimuli, like a puppet on a string being pulled by the financial media. Their portfolio is not a curated collection of businesses. It is a chaotic journal of the last 6 months of financial headlines. The core mistake of the headline chaser is that they confuse information with insight. They believe that by consuming more news, they are becoming a better informed investor. In reality, they are simply becoming more attuned to Mr. Market's mood swings. The vast majority of financial news is noise, not signal. It is focused on the immediate, the dramatic, and the superficial. It provides no context, no sense of intrinsic value, and no long-term perspective. The investor who relies on this noise is doomed to underperform. They are playing a game that is rigged against them, constantly being prodded into action by a media machine that profits from their activity. The practitioner of the Mr. Market and margin of safety framework, by contrast, has built an intellectual fortress against this noise. They understand that the headlines are just Mr. Market whispering in their ear, and they have learned to ignore him until he says something truly foolish that they can take advantage of. The headline chaser is a slave to the present moment. The value investor is a partner with the long arc of time. The direct financial connection between the margin of safety and your portfolio's health is twofold and profound. It dramatically enhances returns and, just as importantly, it fundamentally reduces risk. These two outcomes are often seen as a trade-off, but the margin of safety is the rare principle that allows you to achieve both simultaneously. Let's first explore the enhancement of returns. Buying a dollar's worth of assets for 50 cents provides two levers for future profit. First, you have the potential for the value of the business itself to grow over time. As the company reinvests its earnings and increases its profits, that $1 of intrinsic value might grow to $2, then $4. This is the return from business performance. But second, and unique to the margin of safety investor, is the return from the closing of the price-to-value gap. Eventually, Mr. Market's mood will swing. His depression will lift, and he will reevaluate the business, sending the price soaring from the 50 cents you paid back toward its intrinsic value of $1 and beyond. This re-rating of the stock by the market provides a powerful, often rapid, boost to your returns that is independent of the company's underlying growth. It's a double-barreled engine for wealth creation. But perhaps the more critical financial benefit is risk reduction. For the professional in wealth management, capital preservation is job number one. Buffett's first rule is never lose money, and his second rule is never forget rule number one. The margin of safety is the ultimate tool for capital preservation. When you buy a stock with a 50% margin of safety, you are building a massive cushion against the uncertainties of the future. Let's say your analysis was a bit too optimistic, and the business is really only worth 80 cents, not $1. You still bought it at 50 cents, so you are still protected. Let's say the company hits an unexpected rough patch, and its earnings temporarily decline. Because you bought it so cheaply, the stock price has less room to fall and is more likely to be resilient. The margin of safety is the financial equivalent of an airbag. You hope you never need it, but it provides immense protection in a crash. We can quantify this. Imagine two investors buying a stock with an intrinsic value of $100. Investor A, the speculator, buys it at its fair value of $100. Investor B, the value investor, waits and buys it at a 40% discount for $60. The economy then enters a recession, and the company's value temporarily drops by 30% to $70. Investor A is now sitting on a 30% loss. They are underwater and likely panicking. Investor B, however, is still up. Their $60 investment is now worth $70. The margin of safety didn't just prevent a loss. It allowed them to maintain a profit even in a severe downturn. This is not just a theoretical concept. It is the core of a robust asset allocation strategy. By demanding a significant discount to intrinsic value, you are systematically reducing the risk profile of your portfolio. You are ensuring that the odds are heavily stacked in your favor. It transforms investing from a speculative gamble on the future into a disciplined business of exploiting the emotional folly of others. It is the single most powerful principle for ensuring you not only grow your wealth, but that you keep it. This brings us to our fifth and final pillar, the philosophical capstone that ties everything together and makes strategic inaction the most logical and natural behavior for an investor. It is the business owner's mindset. This is the fundamental reframing of what a stock truly is. To the 99% of market participants, a stock is a ticker symbol, a blip on a screen, a tradable instrument that goes up and down. To Warren Buffett, a stock is a fractional ownership interest in a living, breathing business. He is not renting tickers, he is buying companies. When you buy a share of Apple, you are not just buying the symbol AAPL. You are a part owner of the iPhone franchise, the App Store, the global supply chain, and the brilliant minds in Cupertino. When you truly, deeply internalize this fact, your entire perspective on investing changes. You stop asking, what will the stock market do next? And you start asking, how will this business perform over the next decade? You stop checking prices daily and start reading annual reports yearly. The idea of selling a piece of a wonderful growing business, simply because its price has fluctuated, becomes as absurd as a farmer selling his most fertile field, because the weather forecast for next week is cloudy. The business owner's mindset is the ultimate antidote to the short-term, speculative frenzy that grips the market. It fosters patience, encourages deep research, and makes long-term holding the default option. Why would you trade in and out of your own business? You wouldn't. You would nurture it, you would hold it, and you would let it grow and compound its value for you, its owner. This final pillar is about moving your identity from stock market player to business partner. It is this shift in identity that makes a lifetime of patient, profitable inaction not only possible, but inevitable. The foundational anecdote for the business owner's mindset is, in many ways, the story of Buffett's entire life's work, the transformation of Berkshire Hathaway itself. This isn't a story about a single stock purchase, it's the story of how he embodied the philosophy of ownership to create the most successful financial vehicle in history. In the early 1960s, Berkshire Hathaway was a failing textile mill in New Bedford, Massachusetts. It was a classic cigar butt investment for the young Warren Buffett. The business was dying, a relic of a bygone era, but the stock was trading for less than the value of its working capital. He began buying shares, not because he believed in the future of the American textile industry, but because he knew the company was worth more dead than alive. His plan was to make a quick profit as the company liquidated its assets. But a conflict with the then CEO, Seabury Stanton, led Buffett to impulsively buy a controlling interest in the company in 1965. He was now the owner of a terrible business. He was stuck. For years, he and his new partner, Charlie Munger, struggled to keep the textile operations afloat, pouring the small profits it generated into other, better businesses. This is where the shift happened. Buffett realized that owning a terrible business, even at a cheap price, was a terrible idea. The real path to wealth was to own wonderful businesses at fair prices. He began to use Berkshire Hathaway not as a textile company, but as a holding company, a vehicle to own stakes in other superior enterprises. He bought See's Candies, the Buffalo News, Geico, and large stock positions in companies like the Washington Post and Coca-Cola. He was no longer just a stock picker. He was an owner, a capital allocator, and a permanent partner to the businesses he acquired. He stopped thinking about selling. He famously declared that his, quote, favorite holding period is forever. He saw Berkshire not as a stock to be traded, but as his personal enterprise, a curated museum of the best businesses in America. This mindset dictated every subsequent decision. When he bought a company outright, like the BNSF Railway, he wasn't thinking about a 5-year exit strategy like a typical private equity firm. He was thinking about how that railroad would serve the American economy for the next 100 years. When he bought a massive stake in Apple, he wasn't concerned about next quarter's iPhone sales. He was buying a piece of one of the world's most powerful consumer ecosystems. This philosophy is reflected in his legendary annual letters to Berkshire Hathaway shareholders. He doesn't talk to them as if they are stock market speculators. He talks to them as if they are his fellow business partners. He explains the performance of the underlying businesses, the insurance operations, the railroad, the utility companies. The stock price is an afterthought. This complete adoption of the business owner's mindset is what allowed Buffett to hold on to his winners for decades, letting them compound to an almost unimaginable degree. It's why he never felt the urge to do something during market crashes. He wasn't owning stocks, he was owning businesses, and he knew his businesses were just fine. The story of Berkshire Hathaway is the ultimate proof that the most profound and profitable shift an investor can make is the mental leap from renting stocks to owning businesses. The psychological principle that the business owner's mindset powerfully engages is known as the endowment effect. This is a cognitive bias, first identified by Richard Thaler, where people ascribe more value to things merely because they own them. In a classic experiment, participants were given a coffee mug and then offered the chance to sell it. The price they demanded to part with their mug was consistently and significantly higher than the price that other participants, who were not given a mug, were willing to pay for one. The mere act of ownership created an emotional attachment that inflated the perceived value. For the typical stock trader, the endowment effect is weak or non-existent. They see their holdings as temporary, fungible assets. A share of Ford is just a placeholder until a better opportunity in GM comes along. There is no sense of ownership, so there is no psychological barrier to selling. The business owner's mindset deliberately and strategically cultivates the endowment effect. By reframing the stock certificate as my partial ownership of a business, you trigger that same psychological attachment that the participants felt for their coffee mugs. It's no longer just a ticker symbol, it's my company. This shift has profound behavioral consequences. First, it dramatically reduces your desire to sell. Parting with your company feels more significant and painful than simply closing out a trade. This creates a natural, healthy friction that counteracts the hyperactive tendencies of the action bias. You become a sticky shareholder, which is a prerequisite for long-term compounding. Second, it encourages a deeper level of engagement and understanding. If you own a house, you don't just track its Zillow estimate every day. You take an interest in its upkeep, the quality of the school district, the development of the neighborhood. Similarly, when you feel you own a business, you are more motivated to read the annual report, to understand its strategy, and to follow its progress as a business, not just as a stock. This deeper knowledge reinforces your conviction and makes you even less likely to be shaken out by market volatility. Third, it aligns your emotional state with the long-term health of the business, not the short-term mood of the market. A true business owner feels pride when their company launches a successful new product or gains market share. They are not fixated on the daily stock quote. This emotional alignment is a powerful source of psychological resilience during market downturns. By consciously adopting the language and perspective of an owner, you are hacking your own psychology. You are using the endowment effect, a bias that can sometimes be irrational, for a profoundly rational purpose, to force yourself to think and act like a long-term investor, paving the way for the kind of patient, compounding-driven success that defines the careers of entrepreneurs and master investors like Warren Buffett. To embed this philosophy into your investment process, you can use an applied mental model called the CEO for a Day analysis. This is a deep-dive research exercise that you must conduct before you are allowed to buy a stock. Its purpose is to force you to abandon the mindset of an outside speculator and adopt the mindset of the person ultimately responsible for the company's long-term success. It is the most effective way to truly understand a business before you become its owner. Here is the step-by-step blueprint. Step 1. You are appointed CEO. For one full day, you are not an investor looking at a stock. You are the newly appointed Chief Executive Officer of the company in question. Your first task is to read the latest annual report, not from the perspective of an investor looking for financial data, but from the perspective of the leader who has to write the next one. Read the CEO's letter. Is it honest and transparent, or is it full of corporate jargon and excuses? Do you agree with the strategic priorities outlined? What are the biggest challenges and opportunities facing your district company? Step 2. Meet your team and your competition. As CEO, you need to know who you're working with and who you're up against. Spend time researching the key executives. What is their background? What is their track record of capital allocation? Then, identify the company's top 3 competitors. Do a CEO for a Day analysis on them as well. What are their strengths and weaknesses? How is your company positioned to win against them over the next decade? This competitive analysis is crucial for understanding the company's moat. Step 3. Review the financials as the boss. You are no longer just looking at numbers on a page. These are the results of your terms business. Don't just look at revenue and earnings. Dive deeper. What is the return on invested capital? Is the company generating strong, consistent free cash flow? How is the balance sheet? Does the company have too much debt? As CEO, you have to decide what to do with the cash the business generates. Based on the financials, what would your capital allocation priorities be? Would you reinvest in the business, pay down debt, buy back shares, or pay a dividend? Step 4. Write a memo to your board of directors. At the end of your day as CEO, your final task is to write a one-page memo summarizing your assessment of the business and your strategic plan for the next 5 years. You must articulate in your own words the company's core strengths, its most significant risks, and why you believe it will be a more valuable enterprise in the future. This act of writing crystallizes your thinking and forces you to build a coherent, defensible thesis. If, after spending a full day in the CEO's chair, you are more excited and confident about the company's long-term prospects than ever, Then and only then can you consider becoming one of its owners. The CEO for a day analysis is a difficult and time-consuming process. That is the point. It ensures you will only invest in businesses you understand deeply. It cultivates the endowment effect before you even buy the stock. It makes the business owner's mindset not just a vague philosophy, but a lived experience, setting the stage for a lifetime of patient and profitable ownership. The antithesis of the business owner's mindset is a phenomenon that has become dangerously prevalent in the modern financial era, the stock as a lottery ticket mentality. This is the mindset of the gambler, the speculator who sees the stock market not as a mechanism for participating in the growth of businesses, but as a casino for placing high-stakes bets on price movements. The lottery ticket investor knows next to nothing about the companies they are buying. They couldn't name the CEO, they don't know what the company's profit margin is, and they have never read a single page of an annual report. Their research consists of scrolling through a Reddit forum like Wall Street Bets, looking for a stock with a high degree of social media hype and a funny meme attached to it. They are drawn to companies with high volatility and dramatic stories, a struggling video game retailer, a failing movie theater chain, a speculative biotech with a miracle drug. They are not interested in intrinsic value or long-term compounding. They are interested in the gamma squeeze, the short interest, and the dream of turning a few $1,000s into millions overnight. Their language is not that of business, but of battle and gambling. They talk about diamond hands and paper hands, tendies, and YOLO bets. This approach is the complete abdication of any sense of ownership or analytical rigor. The stock is not a piece of a business, it is a purely abstract token in a digital game. The consequences of this mentality are almost always catastrophic. While a few early participants in a meme stock frenzy might get lucky and make a quick profit, the vast majority who pile in late, driven by FOMO, are left holding the bag when the speculative bubble inevitably pops. They are the ones who buy at the top and ride the stock all the way down, losing 80% or 90% of their investment. Because they have no underlying thesis based on business fundamentals, they have no anchor when the price starts to fall. Their only guide was the hype, and when the hype fades, they are left with nothing but a massive loss and a feeling of betrayal. This mentality is incredibly destructive not just to the individual's finances, but to the very concept of investing. It teaches a generation that the stock market is a rigged casino, a place for quick thrills and devastating losses, rather than a powerful tool for long-term wealth creation. It is the purest form of activity for activity's sake, completely divorced from the productive engine of capitalism it is meant to represent. The business owner buys a company. The lottery ticket speculator buys a ticker symbol. The former is a time-tested path to financial freedom. The latter is a statistically certain path to financial ruin. The direct financial connection between adopting a business owner's mindset and building wealth is that it forces you to focus on the handful of financial metrics that actually drive long-term stock returns. It changes the very lens through which you analyze a company, leading to superior asset allocation and, ultimately, a much larger net worth. A trader, the stock as a lottery ticket speculator, is obsessed with surface-level metrics related to price. They look at things like price momentum, trading volume, moving averages, and support and resistance levels. These are all indicators of Mr. Market's current mood. They tell you nothing about the health or value of the underlying business. The business owner, by contrast, ignores these price-based metrics and focuses on business-based metrics. They are concerned with the financial vital signs of the enterprise itself. First, they focus on return on invested capital, ROIC. This is arguably the single most important long-term financial metric. It measures how efficiently a company's management is at taking the capital it has, both debt and equity, and turning it into profits. A company that can consistently generate a high ROIC, say above 15%, is a compounding machine. It has a magical ability to turn $1 of capital into $1.15 year after year. This is the financial signature of a great business with a strong competitive moat. Second, the business owner is obsessed with free cash flow, FCF. This is the actual cash that a business generates after all its expenses and investments are paid for. It is the, quote, owner's earnings. A company with strong and growing free cash flow has options. It can reinvest in growth, buy back shares, pay dividends, or make acquisitions. It is the lifeblood of a healthy enterprise. A speculator doesn't care about FCF. A true owner knows it is everything. Third, the business owner scrutinizes the balance sheet. They look for low levels of debt and high levels of liquidity. A strong balance sheet is a sign of resilience. It means the company can withstand recessions and economic shocks without facing bankruptcy. A highly leveraged company, on the other hand, is fragile and risky. The financial impact of this shift in focus is immense. Over the long run, a stock's price will inevitably follow the trajectory of its underlying business value. And the business value is driven by things like ROIC and free cash flow. A company that consistently earns high returns on capital and gushes cash will, over a decade, see its stock price rise dramatically, regardless of short-term market sentiment. A company with poor returns and weak cash flow will see its stock price stagnate or decline. By adopting the business owner's mindset, you are aligning your investment selection process with the fundamental drivers of wealth creation. You stop betting on the mood swings of the crowd and start investing in the proven mathematical engine of corporate profitability. This is the ultimate financial transformation. It is the final, crucial step away from the path of the 99% and onto the quiet, patient, and profoundly richer road of the true investor. You have made it to the end, and in doing so, you have done more than just watch another video about investing. You have invested your most valuable asset, your time, into acquiring a mental tool of immense power. You have fundamentally rewired your understanding of how wealth is truly built. You now possess the core principle that animates the world's greatest investor, the profound, counterintuitive truth that disciplined inactivity is the ultimate financial advantage. You have learned to see the market not as a casino demanding your constant action, but as a field of wonderful businesses that will do the work for you if only you let them. This is not a small thing. This is a complete paradigm shift. A key that unlocks the door to the patient, relentless force of long-term compounding. But it is crucial to understand that this powerful model of strategic inaction is not an island. It is one critical node in a network of interconnected principles that form a complete system of thought. You have mastered the art of what to do after you buy, which is, most often, nothing. But this immediately raises the next essential question. How do you find the truly exceptional businesses that are worthy of this lifelong commitment in the first place? How do you identify the Coca-Colas and the See's Candies, the businesses with the unbreachable moats and the compounding engine so powerful that they deserve a permanent place in your portfolio? That is the missing link. It is the other half of the equation. The video that is now appearing on your screen is not a random suggestion. It has been chosen because it is designed to be the next piece of this map. It is the bridge from the philosophy of holding to the mechanics of finding. Think of what you've just learned as the defensive strategy that protects your wealth. That next video is the offensive strategy that allows you to build it. It takes the abstract concept of a wonderful business and makes it concrete, giving you the specific, actionable criteria to look for, the financial metrics to analyze, and the qualitative factors to assess. It is the link that connects everything. So this is not just a choice to watch another video. This is a decision about your own identity. Are you a dabbler, someone who collects interesting ideas but never assembles them into a coherent arsenal? Or are you an architect of your own financial future, someone committed to building a complete, robust, and interlocking system for building wealth? The journey to becoming a truly sophisticated investor is a step-by-step process of acquiring these mental models and linking them together. You have just taken a massive step. The next one is right in front of you. Complete your arsenal. Continue your ascent. Click on the next video and install the missing piece of the puzzle.